Hello friends, welcome to Vericals Learning Vlogs. This is CA Prince George and it's my Income Tax Act 1961 learning series. Today we are going to study section 7, which is income deemed to be received in the previous year. In section 5 we have already studied that both in case of residents as well as non-residents, income which is received in their hands will be taxed, and also certain incomes which in reality they have not received, but it will be deemed that they have received and they will be taxed for it. So which are those income? Section 7 lists down three such incomes which will be deemed to be received by the SSE and taxed in the previous year when it is deemed to be received. First income is the annual accretion in the recognized provident fund balance of the employee. What does this mean, annual accretion? Annual accretion simply means the increase in the balance of provident fund of the employee. Now, why will the balance increase? The balance will increase either because of contribution from the employee or contribution from the employer, or because of the interest that the balance have earned during the year. So does this mean that the entire increment, the entire accretion will be deemed to be income received and tax in the hands of the employee? No, not the entire increment. Increment only to the extent which is provided for in Rule 6 Part A of Schedule 4 will be considered as income deemed to be received in the previous year and will be accordingly taxed in the hands of both resident and non-resident. So what does this rule provide for? So the rule says that where the employer is contributing over and above 12% of the salary of the employee, it shall be assumed that the employee has received the income and will be taxed. Similarly, where the employer is contributing the fund is earning more than 9.5% interest rate, the incremental interest rate will be considered as income deemed to be received in the previous year and taxed in the hands of the employee. So for example, where employees say that the salary is a lakh, say for example, for simplicity's sake, the 12% comes to say 12,000. However, the employer is contributing say 20,000 and not 12,000. So only 8,000 will be deemed to be income received in the hands of the employee in that previous year and taxed. Similarly, where say instead of 9.5%, the interest which is earned is say 10.5%. So only to the extent of 1% will be considered as income deemed to be received and taxed in the hands of the employee. So this was the first scenario. The second scenario is with respect to the transfer of balance into the recognized provident fund. So when does a need arrive to transfer balance into recognized provident fund? It arises when originally the provident fund was an unrecognized provident fund, and at some point the organization went and got it recognized by the Commissioner of Income Tax under Schedule 4 of the Income Tax Act, Part A, Schedule 4 of the Income Tax Act. It got it recognized. So from the year when it got it recognized, whatever balance was transferred from unrecognized provident fund to the recognized provident fund will be subject to tax, but not the entire balance. only that part of the balance which otherwise would have got taxed if the fund was recognized fund right from the inception of the fund. So again the same rules will apply which we just studied. If the employer had contributed over and about 12% or the interest rate was more than 9.5%, if this calculation was done right from the inception of the fund, whatever that amount would come will be taxed in the hands of the employee in the previous year when the fund is becoming a recognized provident fund. So even that will be assumed to be a income in the hands of the employee. And the third scenario is if the employer is making any contribution to any pension scheme which is provided for under section 80 CCD, for example NPS, National Pension Scheme. So where an employer is contributing to such pension scheme for the benefit of the employee, to the extent the employer is contributing, that will be considered as perquisites and got added in the total income of the employee in that previous year. So it will be deemed that it is an income in the hands of income received in the hands of the employee and accordingly taxed. However, we should also see that it gets added and then under 80 CCD it also gets deducted, so it gets nullified, neutralized in some way. So that was all about income deemed to be received in the previous year. Now before we end, I just want to share an interesting point here, that why do we really need a deeming fiction to add the annual accretion in the provident fund account as income of the employee? Is it anyways not income? Just to give you a comparison, when we do a fixed deposit, a long-term fixed deposit, the maturity happens only after 5 years, but we are required to pay tax on the interest that we earn on the fixed deposit every year. Though maturity is happening, we are actually receiving it much later, right? So we are not receiving anything, but still we get taxed. So there is no requirement for a deeming fiction, because that interest is anyways arising, and the income can be taxed either when it arises or accrues or it is received. So isn't the same rule apply in case of provident fund interest as well? Can't it be taxed, not just the interest but also employer's contribution? Can't it be taxed basis the fact that it may not be received but it is arising, right? So the only answer to this that I have is provident fund stand at a very different footing than a fixed deposit. A provident fund has it's far more regulated, is far less accessible to the employee, to the SSE, than is an FD. You can't simply go and withdraw provident fund. There are regulations, there are rules, there are conditions before you withdraw it. So it stands at a very different footing than a fixed deposit. More importantly, it is not so easily accessible, so it is not as liquid as a fixed deposit. So it is possible that in absence of a deeming fiction, it can be claimed that the interest or employer's contribution is not even arising. It is not even an income which is arising. How can one tax an income which is not accessible, which is not utilizable for the for the income earner. So probably the legislature must have felt that in order to avoid any litigation or different interpretation of the provision of this kind of an income, provident fund, uh, which is arising in provident fund, it is important to have a deeming fiction, and that's the reason why I believe section 7 is there with respect to provident fund. So fine, thank you so much friends. If you have any queries, do write, put a comment, or just give me a call. You can connect on LinkedIn as well. Some of you have indeed connected with me on LinkedIn. Thank you so much.